I've raised over $1 billion. And as Robert Kiyosaki says, there's one skill that separates all successful entrepreneurs, and that is the ability to raise capital. If you want to scale your business, you must master this skill. But here's the catch. If you do this wrong, you could end up in serious legal trouble. That's why today I'm sitting down with my syndication attorney, Mauricio Rauld, to break down exactly how to raise money legally.
Can you always talk about the fact that only lazy people use their own money? If you were starting over again, how would you go about raising your first million?
Yeah, the reason I say that is because I have investments in all my deals, and I could use my own money to buy deals, but then I would really stay small because nobody has that much money if they really want to scale. Right. So if you're going to scale, you have to you have to put it in lots of different deals and then go out and find people to help you move at that kind of pace, right? There's no way to scale and not be able to raise capital. So that's why I say that. But also what I found is that there's a lot of people that are looking for really good operators, looking for really good deals, and they're looking for investments. And so once I tapped into that, once I realized that there's a whole bunch of limited partners out there looking for good operators and good deals, that's when I realized this is a big, big space. And I think when you first start out, you don't really want to have partners. A lot of people are partner averse, which is totally fine. I totally get it, right? Because who wants to be beholden to other people and have to do all the reporting and all that kind of stuff? I completely understand that. And it does put you at a little more risk, right? But it also, in a good way, makes you accountable. It makes you be transparent on what's happening, or at least you should be. So when I coined the term that only lazy people use their own money, what I was trying to say is if you're using your savings to invest and then generating more savings and investing again, you're really, really, really slowing the process down because there's a lot of really, really good people out there looking for great deals just like you. And that's the OPM or other people's money category. But you just got to be careful on how you raise it. I think a lot of people use money as an obstacle to move forward, even take a step, right? And so what they say is, I don't have the money. I can't start. I need the money. I need to have savings or whatever. And I actually believe that the real issue is that they're just afraid to make a commitment to actually buy a property, let's say, or buy an investment or invest their own money because they don't have the confidence. And so why would you raise more money from other people if you had that? And so I always tell people that raising money is actually the easy part. I believe that. Finding the deal is the hardest part. But once you find a deal, my experience has been the deal makes sense to people if you can show them how it works. And the raising the capital and the business plan are actually more of a formality. So I found this to be the case with my real estate deals. As we started to raise money, we would find a really good deal and it made sense for us. Like it had a good story, had a value add component to it. And we had we had a beginning, a middle, and an end to it. And so there's an investment journey. I found the same thing to be with my billboards. The billboards, same thing. They have the bonus depreciation. They have the cash flow. There's a beginning, there's an end, there's a 40-year lease. People understand it. It's a real simple business. So I found that once you put all that together, then the traction of the capital is actually quite easy. The problem is you're just in the wrong rooms, right?
What do you mean by that?
Well, I think a lot of people don't know, right? So they blast it out on the internet when there's a lot of like we were talking today, you're going to this, quasi mastermind tonight, right? Yeah. And there's 100 to 120 people there. For sure, half of them are investors or they're syndicators or raising capital. That's just being in the right room. And you live in California and you're here in Arizona. That's my point. If you're just in the right rooms and you have a deal, or whether it's Limitless or whether it's Rebel Capitalists or whether it's a Goals Retreat or whether it's the New Orleans Investment Conference or wherever you are, if you have a deal brewing and you're in an environment, you're going to raise the money. Hey, everybody. Do not miss our emergency seminar this Monday, April 21st. Join me, Tarl, and our special guest, George Gammon, as we break down what is really shifting in 2025. This is a can't-miss preview of what's coming up at the Limitless Expo. You want to be ahead of the curve. Reserve your spot today.
Yeah.
Right?
Yeah. And you also talked about the idea of raising capital, also educating investors, because, for example, they've got their IRA that's all locked up. That's money that they don't even know could be used to invest in some of
That's a really good point. I think that, well, first of all, most people understand what a retirement plan is. And we tapped into this back in the early 2000s up in Canada through the RSP, or Retirement Savings Plan, which is basically the U.S. equivalent of a 401k. But call it a retirement plan. It could be a pension, it could be a self-directed IRA, or it could be a Roth IRA, it could be an IRA, it could be any of those things. Once we realize that people can actually take control of their own retirement funds and move them over into an account that they control through an independent third party called a self-directed IRA, all of a sudden people started realizing, they started getting kind of that financial freedom back, and that knowledge and that power back. And we have a lot of people that invest through self-directed IRAs right directly into our deals.
And that's just a question of educating them, because a lot of people just don't know that they have that option.
Yeah. So I'm sure a lot of people don't realize that, when you work somewhere, let's say, and there's a percentage of your paycheck that goes into a retirement account, and sometimes it's matched by an employer, and that's all managed by somebody else, that money is actually yours. You can request that money to be moved into your self-directed IRA and then invest it on your own, right? The only difference is, one, you turn it over to somebody else to do it, or two, you do it yourself. So the biggest lesson I learned by raising well over $1 billion in my 30-year career is when to stop. That's what actually people are starting to learn right now. So as you know, we pulled back 3 years ago because the deals stopped making sense. So just because you can raise money, and just because you have raised money, and just because you've done it, and what happens, it goes straight to your head, straight to your ego, and you think, oh my gosh, it's me, but it's not. It's the deal. Once the deals stop producing like they have, for example, like we just saw, as the prices went up and interest rates went up and operating expenses go up and all those kinds of things, people that were raising money continued. And they didn't have a stop switch or even a pause switch.
Yeah.
And so that's actually what we're seeing now. So that's the biggest lesson and the hardest thing, because we have a whole company and a whole department set up to buy buildings, manage buildings, develop buildings, invest in buildings, investor relations, all that stuff is all set up to acquire.
Yeah.
And so for us to put a pause on that, or even a stop on that, frustrates a lot of our staff, and it's hard to do.
And I think a lot of syndicators who were scaling, because a lot of them scaled a lot during 2021, 2022, they were basically financing their operations through acquisition fees and acquiring properties. And so if they stopped acquiring, the cash flow basically stopped going, because syndicators typically don't get paid until the end, or a refinance or something. So without acquisitions, they just weren't getting fees, and they would probably have to shrink their personnel. I think that was one of the big motivations for a lot of these folks to keep going.
The deals stopped making sense financially. So when that happens, everyone knows. Then the question is, who buys it? That's it, right? So you're right, that did happen. I'm sure they had overhead and all the things they're trying to do to cover all that. But everyone's bidding on the same thing. And when Ross and I were losing deals, first we were always in the top 5. Then we were in the top 3, let's say. And then we were not even close. We were at the bottom of the list, and people were paying $1 million, $2 million, $5 million more than we were. And we had the exact same numbers. We had the same financials. We had the same rent rolls. We had the same rents. We had the same property, same names, same debt, same interest rates. Everything's the same. And when you got 20, 30, 40 people bidding on one property, you're always going to have those outliers, the person that's going to pay too much.
But what's not the same are the assumptions. Like
Correct.
The underwriting and your assumptions, you guys are very strict. You stay within your parameters. You don't veer away from that. You can make any deal work on paper.
I'll tell you what's interesting. This is kind of behind the scenes, but if there's 30 offers on a property, and this happens all the time, and there's 2 or 3 that are way ahead, a lot of times the brokers just throw them in the trash. They're like, oh, this is a group we've never used before. And most deals everybody's clumped within $200,000 to $300,000, almost always. And then it's always, can you perform? But every once in a while, when you got somebody way out there, maybe they got a fund or a 1031 or something. And of course, as a broker, you're going to do the best you can for your seller. You're going to take whatever you can take. And we just saw that, obviously, in the last few years. And that's actually what's starting to show up right now.
Ken, a lot of LPs are pissed these days because, for a lot of good reasons, but one of them is they're just not being communicated with. And you taught me many, many years ago that communication builds trust, that as things go worse and things aren't going well, you should double or triple down on your communication. Talk a little bit about that, because that's super important. And I think a lot of syndicators are losing future business by not following that advice.
Well, I think the biggest thing is you have to let people know kind of what's happening at all times, right? And so we have a process. We send out quarterly investor updates, as an example, and there's a lot of communication. And we have a whole investor relations department, obviously, handling these kinds of things. And the big issue is if you've got a loan coming due, or you have a cash call or something like that, it's going to change the deal. And so those are the things that we believe you have to be able to communicate well. And it's not fun. Even in the last few years with the interest rates that have gone up, we've had our own challenges, and as have everyone. And, we just make sure that it's papered, right? We got to paper it up, send the email out. This is what the property's worth. This is what's going on. Ross and I had a deal where we funded over $6 million personally on one deal ourselves, just to kind of keep that deal together.
Yeah.
And, it's just important that they understand that, everybody's communicated to as things are going sideways, up, down, everything that's happening right now. You can over communicate too. What I mean is, something can happen one week with a conversation with a lender, and it can change a week later. So you can also frustrate, so you got to be careful and let things kind of play out and get more certainty around each piece.
So one of those deals, I remember you anticipated that like 12 or 18 months ahead of time. You knew there was a loan that was coming due, and you guys proactively addressed that 18 months. Didn't wait or pray to things to get better. You were pretty proactive on that one.
Well, we did a couple cash in refinances.
Yeah. What is that?
Well, a lot of people know what a cash out refinance is, which is when you refinance a property and you take cash out tax-free, or tax deferred, I should say. Cash in means we think rates are going to go up, and so we want to lock our interest rate instead of being on a floater. And so we wrote a check to actually get a fixed rate so that we knew with certainty what our mortgage payment would be each and every month.
Yeah. Yeah, I don't think too many people have done cash-ins.
Yeah. Well, we didn't want to.
Yeah.
But, as rates started to go up, you got to hedge everything. And that's part of actively managing your portfolio. But we also got caught on some deals where, we had severe negative cash flow, and we had cash calls and all that stuff, just like everyone else. And so part of that is just being able to communicate to everybody, through emails, through texts, through phone calls, through video, through letters, and through all those kinds of things. And when you don't communicate well, that's when people start getting upset, right? And people still get upset. Nobody wants to lose money, right? Including me, but it does happen in this business. And
well, I think it was at your Limitless event. We were on a panel with, I think Brandon Turner was talking about this, where he's got two investments, two different syndicators. He's going to lose his money on both. But on one of the deals, the sponsor's communicating, letting him know what's going on, and the other one completely disappeared. He's not going to ever invest with the sponsor that's not communicating, but he may invest in the future, because everybody understands people, not everything goes according to plan, but the lack of communication, I think, is just going to ruin your reputation.
Yeah, without a doubt. So Mauricio, what is the very first step an investor should do before they raise capital?
Well, the first thing they got to figure out before they raise capital is understanding whether what they're doing is selling securities or not. There's so many people out there that think that, hey, this is just a promissory note, or hey, this is just a joint venture, or hey, this is just friends and family and it's like a small deal, that I'm not in the business of selling securities. When in reality, most people are. So if you're going to be raising capital, it's critical for you to understand that what you are doing is selling securities to your investors, and you have to comply with securities laws.
So how do you know, like, what's black and white? To you, it's super black and white. To a lot of people, it seems to be gray.
Yeah, well, it is gray. I mean, these are the U.S. laws. There's never really a black and white answer. But the English translation that I like to tell folks about whether something's a security or not is the following. Anytime you take money from passive investors where the returns are generated by your efforts, meaning you're doing all the work and the investor's just writing you a check and going home, that's a security. That's a modification of something that we call the Howey test, which is a Supreme Court decision, but that is how you determine whether something's a security or not.
So it's interesting because this does not have to be in real estate, right? No. This could be at a very low level.
Yeah, the real estate is something that I specialize in, and so most of my clients, like yourself, are real estate syndicators. But this can be a crypto fund. This could be raising capital to buy a company, to invest in private equity, to buy precious metals. I mean, raising the capital is what we're talking about. What you invest that money in can be basically anything.
That makes sense. So that's the very first thing, is determining whether it is a security. And the reality is, if you're going to raise money, which most people do, they're going to fall into the security bucket.
Yeah.
Right.
And look, let's be honest. It doesn't always make a ton of sense, especially if you're in the real estate world, because, why securities, right? Why is the Securities and Exchange Commission in my business? I'm just trying to buy a freaking building, right? But yeah, the definition of a security is very, very broad. And so then the next step is understanding that once you understand that you are in the business of selling securities, then you have to realize that you either have to register that security with the SEC, the Securities and Exchange Commission, or you need to find an exemption to registration, or it's illegal.
First of all, I think you should just assume that it's a security.
Yeah.
Right? Because trying to get around that is, shouldn't you just automatically say, okay, it's going to be a security and it needs to be?
I think so. I think if you're raising money, you should make the assumption that it is a security and then contact a securities attorney and just confirm that. A lot of people just assume it's not, and therefore don't even worry about having it.
That's the worst thing you could do. Okay, so the first thing is to register it. So walk me through that.
We don't want to register. Like in our world, we never register. Register is going public. Doing an IPO or something.
Super expensive.
It's expensive. It's time consuming. And look, when you, especially in real estate, when you are in contract to buy a building, as you know, you've got 60, 90, 100 days to close. You don't have time to go spend a couple of years to get your securities approved by the SEC. You don't have that kind of time.
If you're raising money for a syndication, then that means you have to raise money to actually pay for the legal fees for it to register.
Yeah, so it doesn't make any sense. It's going to cost you 6-7 figures. It's going to, like I say, take you a couple of years. So the idea is we're not going to register. That's not the avenue we want to go.
Because I know, just to put things in perspective, putting a fund together, or a REIT, or a public or a private or a public REIT is millions of dollars, right?
Yeah. On legal fees. Yeah, because imagine you've got to submit all the information to the government, right? And then there's a government attorney that you work with, and you're going back and forth for years.
So this is definitely not the first step. So then the second step would be the exemption.
Yes, and that's my world. So you're always looking for an exemption, and there's a ton of different exemptions, but there's two exemptions that are by far the most popular. I know you've used both of them, and these are exemptions that we call Reg D, Regulation D exemptions, not to get too technical. And this is as technical as we're going to get. There's two primary exemptions that you will rely on. Rule 506B exemption or a 506C exemption. Those are the two exemptions that I guarantee you'll be using one of those two, especially if you've never raised capital before. This is your first foray into it. 506B or 506C is going to be your choice, and the decision then is which one do you pick.
And this is where most people land, right? Because on the 506B and 506C is as difficult as it gets from a legal standpoint, right? You just have to know the difference between the two.
Yeah. And the difference is actually not that hard. They're very, very similar exemptions. The pivot points are there's two things. One is, and these are the questions I typically ask a client, do you want to take non-accredited investors in your deal? That would be question number one that I would ask. And just so we don't leave anybody behind, an accredited investor is someone sort of a high net worth individual, right? Somebody who has $1 million in net worth, excluding their primary residence, or has high income, $200,000 a year, the last couple of years with a reasonable expectation of doing that this year.
And if you're confused about that, the accredited piece, the SEC has determined that for you.
Yes.
Right? So
yes,
this is not arbitrary.
Yeah, there's no arbitration here. You're either accredited or you're not. But that is black and white. We talk about that is a black and white thing. Are you accredited or are you not accredited? So 506B allows you to take a limited number of those non-accredited investors. As long as they're sophisticated, as long as you keep it under 35, you can take non-accredited, which is a big deal for first-time syndicators if you're just starting out. because inevitably, Uncle Bob, Aunt Karen, your buddy from high school, like somebody in that group is going to be non-accredited. So 506B is a great avenue to get those into your deal as you get off the ground.
Right. And then the other is the 506C, which basically means that you don't have a pre-existing relationship and you advertise out on the internet.
That's the second pivot point is, do you want to advertise or not? Because if you want to advertise, 506B is not for you, because even though you can take non-accrediteds, you cannot advertise, you cannot generally solicit, you can't go on Facebook, you can't go on social media, you can't go on podcasts. You generally have to have what's called a pre-existing substantive relationship with your prospect. In other words, it's a private offering. It's meant for the people in your inner circle, your friends, your family,
so
people you already know.
Let's give a couple examples. Yeah. So like a 506B would be your friends and family.
Yeah, that's exactly.
Right? So that would be, you go to your uncle, if you had a rich uncle, or, your parents, or whoever it might be, somebody in your circle already that you go and say, I'm going to do this deal. Are you guys in? You raise 25 grand, 50 grand, 100 grand each, or whatever it is. That's 506B. They're self-accredited.
Correct.
The minute you don't have enough money and then you put it out on the internet, let's say, out on Facebook, now you've actually crossed that line, right?
Yep. So that if you want to advertise, then you have to rely on another exemption. And the most popular there is the 506C, which does allow you to advertise. It does allow you to generally solicit. However, it does limit you to accredited investors only.
Yeah. And they also have to go through a process of accreditation.
Yep. You have to take, you as the sponsor, you the capital raiser has to take what's called reasonable steps to verify that your investor is in fact accredited.
And that actually can be extensive. Like you have to get tax returns or a letter from the CPA, et cetera. Whereas 506B is actually self-accredited.
Yeah. And a B, we just send out a questionnaire. They check the box. We rely on it. On a 506C, you generally want to hire either third-party verification companies, or what I generally recommend, or like you said, you can get a CPA verification.
That's what we do. We have a third party that verifies all our accredited investors, and then we're good for, I think, 5 years.
Yep. Exactly right.
Yeah. On a 506B, which would be friends and family, let's say my brother wanted to throw some money into the deal, I don't have to go through that.
But that's one of the biggest mistakes, though, Ken. Like, I literally had a buddy of mine who raised money for a wine company. He developed a wine that I guess you drink in a can, which for us wouldn't work. But anyway, so he raised a bunch of money from friends and family, and he was under the impression that because it was just friends and family and people he knew, and he wasn't advertising, that he wasn't even selling securities.
Oh.
And it's important to understand that if it's friends and family, great, but it's still a security, and you've got to find that right exemption, which is going to be 506B. It's not the end of the world, but you are selling securities. Just because it's your friends and family or your parents or your uncles doesn't mean you're not in the business of selling securities.
So let's talk about the book you wrote, Legal Strategies for Everyone, because I think everybody should pick this book up, especially now, right? Let's talk about some of the strategies in there.
Yeah, so obviously this is at your request, Ken. If it wasn't for you, I wouldn't have ever gotten around to writing the book. But for KM Press here, but Legal Strategy for Everyone, it's really meant for everyone, and it's sort of an introductory guide of how to work with attorneys, how to protect your assets. A lot of stuff on asset protection here as a former retired asset protection attorney, estate planning, just really introductory legal concepts, really for everyone. And so you want to check it out, it's on Amazon, pretty much anywhere you can find it.
I just sat down with some of the biggest real estate investors in the country. In this next video, I go over where and what they are buying, and more importantly, how you can use this information to make educated decisions.